Hello students, this is Arshad Butta. Uh, Today I am going to discuss the first lecture regarding financial management or time value of money. Kindly subscribe my YouTube channel, Arshad Butta Official. This lecture is suitable for the students of ACCA paper F9, paper F2, as well as CMA USA Part 2 students, as well as for the students of ICMAP exams as well as CA Pakistan's exams. And CA India exam students can also get benefit from this lecture. And this lecture is equally suitable for the students of MBA Finance or BS Accounting and Finance. Those are taking the subject of financial management or corporate finance. If you will like my lecture, then kindly subscribe my YouTube channel and press bell icon. Then you will get the notification for upcoming videos. Let's start the discussion. What is the agenda of today's discussion? Today we will talk about what is time value of money, what is compounding, what is discounting, what is single cash flow and how to calculate its present value and future value, what are multiple cash flows, what is annuity and types of annuity, how to calculate present value and future value of annuities, how to calculate present value of perpetuity, what is growing perpetuity and how to calculate its present value. So this is the agenda of today's session. So let's start the discussion with what is time value of money. Time value of money says that the equal sum received today has greater value than the equal sum will be received in future. So it means like today in time value of money, today's time is year 0, it's time 0. Let's assume 100 you are receiving today, that has greater value than the 100 you will receive after 1 year. Okay, the reason why this happened, there are 3 reasons. Potential of earning interest. There is a possibility that if you will earn by 10% on this 100, it would be 100 times 10% equals to 10 plus principal amount of 100. It means it would be 110 after 1 year. So this is the first reason, potential of earning interest. Then second reason is impact of inflation. There is a possibility that the 100 which you have today, with that 100 you may get the bigger basket of goods. The buying power of this 100 is higher than the buying power of 100 which you may have after 1 year. Let's assume today's price of tomatoes is $50 per kg. I'm just assuming the figure, it's a hypothetical figure. So it means if you are having $100 today, you can buy 2 kg of tomatoes. But if after 1 year, due to the inflation, this price is say 60, then you would not be able to buy 2 kg at with that 100 which you have after 1 year. So due to the impact of inflation, you would not be able to buy the same quantity of commodities with that particular amount. Then third one is effect of risk. There is a possibility that after 1 year there would be a lot of uncontrollable factors, and due to those factors you would not be able to receive the 100 which you are expecting after 1 year. So due to these 3 reasons, it is concluded that the equal sum received today has greater value than the equal sum you will receive in future. Now let's talk about what is compounding. So compounding is a process in which an asset's earnings from either capital gains or interest, whether you are getting the capital gain or interest on your assets investment, are reinvested to generate additional earnings over time period. This growth calculated using exponential functions. What is exponential functions? I will elaborate later on. Occurs because the investment will generate earnings from both its initial principal and accumulated earnings from preceding periods. So what is the meaning of this? There are two possibilities. One is called linear relationship, in which that is also called simple interest method. Under that method, you are getting the interest or gain on only principal amount. Let's assume you have invested in bank A $100 and the rate of return is 10%. At the end of year one, you will get 10. At the end of year two, you will get again 10. 100 times 10%, only on your principal. In year three, you will again get 100. So your total return in the form of interest would be 30 plus your principal 100. You will get in total 130. On the other side, under exponential function, what will happen? On your $100, in year one, you will get 10, 100 times 10% equals to 10. In year two, this 10 will become part of your, along with your principal, to get the return, because it is mentioned here, principal and the accumulated earnings from preceding year. So here you will get one interest on 110. So 110 times 10 is equal to 11. Now for year third, it will again be added. So it would be 121 times 10%. So it is 12, and your total figure in terms of interest would be 33 plus 100 your principal equals to, you will get in total 133. So this factor is called exponential function, when you are getting the return on your interest or earnings which you have earned in previous time period. So keep in mind, all whole syllabus of financial management is dependent on this concept, compounding. Even though in your all financial institutions in the world where capitalistic economy is prevailing, compounding interest method is used. It means you are earning interest on interest, or you are earning on your earnings which you have earned in your previous time period. Now look at this function. If you are supposed to get the figure here, this is called, you are doing what? Compounding. Like what you will earn after 3 years time period. You have invested today, like I have done in this example. So you are supposed to get the figure at year 3. Then what is discounting? So discounting is the process of determining the present value of the of a payment or a stream of payments that is to be received in the future. Why we are doing so? Because we have established the fact that the amount which you will receive in future, equal amount, don't have same value. So to determine the value in 2 days term, we are supposed to discount future payments to get their present value. What is this? You are bringing the values of your future time periods. Like you have one figure here. If you want to get the value at this level at year 0, that is called what you are going to do, discounting. Let's assume you have this pattern of cash flow at year 3. If you want to get its value at year 0, what you are doing discounting. Then we have another term which is called, what is single cash flow? When we have only one cash flow on our timeline, when we have only one cash flow on our timeline, like this is our timeline, 3 years timeline. Keep in mind, in time value of money concept, in financial management, 2 days date is always year 0. So if we have only one cash flow, like we have here one cash flow at 2 days time period. So this is called single cash flow. Then there is another example. Again, we have 3 years time period timeline, and here again we have only single cash flow at year 3 time period. So if on your whole timeline you have one cash flow, that is called single cash flow, irrespective of at which time period it is. How to calculate present value of future value of single cash flow? Let's assume we have 2 days date value which we have, that is present value, and if we want to calculate the value at any future time period, that is called how to calculate future value. Let's assume we want to calculate this value. For this purpose, we have one formula, which is future value is equal to present value times 1 plus r per n. As I discussed earlier, FV for future value, PV for present value, R for cost of capital or interest, or which is also called required rate of return, and N for number of periods. So let's do the calculation. Say we have this 1002 days time period, and we want to calculate the value at future value. What we will do, and our cost of capital is say 10%. Cost of capital is 10%. Now we want to calculate at which date? At year 3. This is number of periods, n. So 1000 times 1 plus r. Always convert your interest rate into decimal. So 10% is converted into decimal, it is 0.10. So 1 plus 0.1 x raised power 3. So let's do the calculations. 1.1 x raised power 3 equals to 1.331. So equals to 1.331 times 1000 equals to 1331. So this is your future value. It means if you will invest 1000 today, it would be 1331. So let's do the calculations by a simple way. For instance, 1000 times 10% is equal to 100. So for year 1 you have 100. For year 2 this will be part of your principal amount. So it would be 1100 times 10% is equal to 110. Now this we will add, it would be 1210 times 10% is equal to 121. So in total, it is 133. So this is interest figure. Plus you will add your principal, which is 1000. So in total, it would be 1331. So this is the way. We are not supposed to do these bigger calculations. We will just use this formula and we will calculate the future value. Okay, got it? So this factor, which is 1 plus r power n, this factor is called compound factor. You can, even though use the table which would be given to you in your exams, in your respective exams, from where you can find this compound factor. One way is you will use this formula 1 plus r power n to calculate the figure of compound factor. Otherwise, you can use in your timetable over there, you will find by using your cost of capital and number of periods from there, by matching the figures, you will find your compound factor. Then, how to calculate present value of single cash flows? Previously, we have discussed how to calculate future value of single cash flow. Now we will talk about how to calculate present value of single cash flow. Let's assume again we have 3 years time periods timeline and we have future value and we want to calculate present value. Let's assume this is again 1000 future value and we want to calculate present value. This is question mark. In that case, the formula is PV is equal to FV times 1 plus R power minus N. R, it could be elaborated in this way, or FV times 1 divided by 1 plus R power N. So this is just, we have done the mathematical, when denominator will go upward, the sign will be changed. So normally we are using this figure. Whereas again, FV for future value, PV for present value, R for cost of capital, and N for number of periods. So here we have again 3 years time period. So PV is equal to 1000 times 1.10. As I discussed earlier, that we will convert the cost of capital into decimals. I am assuming that cost of capital is again 10%. Now power minus 3. So 1.1 x raised power minus 3. This is called 0.751. So this figure is 0.751 times 1000. So our figure is 751. So keep in mind, present value will always be less than your future value. Now we have done the calculation to calculate this figure. Now keep in mind what is called 1 plus R power minus N. It is called discount factor. Again, we can use either table, either we can use this formula to calculate the discount factor. So this is the way how we can calculate future value and present value of single cash flows. Then we have multiple cash flows. What is meant by multiple cash flows? When we have more than one cash flow on our timeline, we called it multiple cash flows. Let's check this uh, timeline again, 3 years timeline, but here we have 1000 at time 0, 1000 at time 1, 1000 at times 2. Again we have another timeline where we have 3000, 2000, 1000, 3000 at time 1, 2000 at times 2, and 1000 at times 3. So the criteria for multiple cash flows is when you have more than one cash flows on your timeline, that is called multiple cash flows. Now, types of multiple cash flows. First one is called annuity. There are two characteristics of annuity. Number one, same cash flows, and you have time limit for certain time period. Either it's 1000 year, either it's 2 years, either it's 5 years, but you have any time limit. In that case, we will say that it is annuity. So annuity have two characteristics. One is same cash flow. If you have different cash flows for a certain time period, it will not be considered as an annuity. Annuity characteristic is same cash flows for certain time period. Then we have perpetuity. This is called same cash flows but for infinite time period. So the difference between perpetuity and annuity is perpetuity is not time bonded. It is for infinite time period. On the other side, annuity is for a certain time period. So same cash flows, if they are for certain time period, it is called annuity. If uh, same cash flows for unlimited time period, it's called perpetuity. Then we have mixed cash flows. For certain time period, it is time bounded, but different cash flows. But different cash flows. In our previous slide, when we talk about multiple cash flows, we have drawn two timelines. In one timeline, we have 1000, 1000, 1000 for year 0, year 1, year 2. That was annuity. Certain time bounded, same cash flows. But in the second timeline which we have drawn over there, we have different cash flows for certain time period, year 1 to year 3. That is called mixed cash flows. So let's discuss the types of annuities. Annuities have three types. So the principal difference between these three types is their starting point. Other characteristics, same cash flows for certain time period is equally applicable on all types of annuities because that is the principal criteria to declare any cash flows as an annuity. But what is ordinary annuity, which is started at year 1? So the first type of annuity is ordinary annuity, and it is always started at year 1. Now let's discuss, this is the timeline. Same cash flow time bounded from year 1 to year 3 and same cash flows, and it is started at year 1. So that's why we called it as an annuity. Then we have annuity due. It is also called annuity received in advance. Annuity started at year 0. So the principal difference between ordinary annuity and annuity due is annuity due always started at year 0 time period. Okay. Now let's discuss again. This is 3 years annuity, but its starting point is year 0. So it is starting at year 0 and ending at year 2. In total, it is again 3 years annuity. It is also 3 years annuity, but its starting point is year 1 and its starting point is year 0. So the principal difference between ordinary annuity and annuity due is their starting point. And the third annuity is delayed annuity. It is an annuity, means same cash flows for certain time period, but it is always started at any time period after year 1. It is always started at any time period after year 1. Let's assume now we have 4 years time period and annuity is for 3 years, which is going to start in year 2. In that case, it is delayed annuity. We don't have any annuity at year 1. So again, I'm just summarizing the difference between the three types of annuities is annuity, ordinary annuity is starting at year 1, annuity due is starting at year 0, and delayed annuity is starting at any time period after year 1. Now, how to calculate future value of ordinary annuity? If we have ordinary annuity, how we will calculate its future value? Future value means we are supposed to get the value at any future time period. Let's assume we have 3 years annuity, year 1, year 2, year 3, which is ordinary annuity, and we want to calculate future value. Formula is annual cash flows times 1 plus r x raised power n minus 1 divided by r, and this whole factor is called annuity compound factor, whereas future value, cost of capital, number of periods, same things. So it is annual cash flows times 1 plus r x raised power n minus 1 divided by r. Now let's do the calculation. Say our annual cash flow is, like in this example, is 1000. We are assuming that our cost of capital is again 10%. So 1.10 x raised power 3 minus 1 and whole will be divided by r 0.1. So again we will do the calculations. 1.1 x raised power 3, it is equal to 1.331 minus 1.331 divided by 0.1, so it is equal to 3.31. So it means 1000 times 3.31 equals to 3310. So let's do the calculations with a simple method. So from here to here, how much time period we have? 2 years. From year 1 to year 3, 2 years. From year 2 to year 3, 1 year. And from year 3 to year 3, 0 year. So let's do 1000 times 1.1 x raised power 2, 1000 times 1.1 x raised power 1, and 1000 times 1.1 x raised power 0. So this will always be, when your power is 0, your factor would be 1. So it is 1000. I'm just doing this calculation to explain the concept. So 1.1 x raised power 1 is equal to 1.1 times 1000 is equal to 1100. So that 1000, 1.1 x raised power 2 equals to 1.21 times 1000 is equal to 1210. So this is 1210, and if we will make the sum of these three, it would be 0, 1, 1 and 2, 3, and 3, 3, 3, 1, 0. So the same figure which we have calculated here. So annuity factor, what I want to explain you, annuity either compound factor, either discount factor, is sum of the compound factors of discount factors of that particular period involved. Okay, so to simplify the things, we will just use this annuity compound factor formula, and we will calculate the figure. So we have calculated 3310 as a future value. Then how to calculate present value of ordinary annuity? Again, ordinary annuity is annuity which is going to start at year 1. So this is 3 years, same annuity, but we want to calculate what? Present value. The formula is PV is equal to annual cash flows times 1 minus into 1 plus R per minus N divided by R. 1 minus 1 plus R x raised power minus N divided by R, whole divided by R. And this figure is called annuity discount factor. So whereas present value PV, R cost of capital, N number of periods. So let's assume our cost of capital is again 10%. In that case, 1000 times 1 minus into 1.10 x raised power minus 3 divided by 0.1. So let's do the calculations. 1.1 x raised power minus 3, which is 0.751, 1 minus answer divided by zero point 0.1 is equal to 2.487. So 1000 times 2.487 is equal to 2487. Now we have calculated the present value of future annuities. So it is 2487. Got it? Now, as I discussed earlier, that annuity discount factor is the sum of discount factors of period involved. Let's assume from here to here, 1 year. So 1 year discount factor is 0.909. From year 2 to year 0, 2 years. So 2 years discount factor is 0.8. Let's do the calculation. X raised per minus 2, 0.826, 0.826. And from year 3 to year 0, 3 years, and year 3 discount factor is 0.751. So let's do the calculation. 826 plus 0.751 plus 0.909 equals to 0.487. So this is same sum of the discount factors of period involved. Okay. Now, how to calculate future value of annuity due? So the difference between, oh, big apologize that here this figure would not be here. It is an annuity which is going to start at year 0. So this is like 3 years annuity which is going to start at year 0. So 1000, 1000 and 1000. And here we want to calculate future value. So here formula is future value is equal to annual cash flows times 1 plus R x raised per N minus 1 divided by R times, we will do just one calculation, 1 plus R. So the same formula which we have used for ordinary annuity, we will just add one more thing, 1 plus R. So annual cash flow 1000, if we will use the same calculations. So 1.1 x raised per 3 minus 1 divided by 0.1 times 1.1. So let's go on the previous slide where we have calculated the calculations of, so it was 3.31. The first thing which we have done, that was 3.31. So it is 3.31 times 1.1 multiplied by 1000. So 1000 times 3.31 times 1.1 equals to 3.641, is equal to 3641. So this is the future value of annuity due. Simple. The thing to cram is you must have to be very good to cram your uh, formulas. Here you will just add 1 plus r in your ordinary annuity formula. It is called annuity due compound factors. Okay. Now, how to calculate present value of due annuity? How to calculate present value of due annuity? Again, there is a typo error. Sorry for that. It is about due annuity. And again, this should not be here. It should be here. So 3 years annuity starting at year 1. So again, the formula would be 1000 times 1 minus into 1.1 x raised power minus 3 divided by 0.1. Same formula which we have used till used for ordinary annuity times 1.10. So this figure was 2.487. So we will multiply it with 1.10 times 1000. So it is 1000 times 2.487 times 1.1 equals to 2.736 times 1000, 2736. Again, simple thing is just we are supposed to add 1 plus r in the formula which we have used for ordinary annuity present value. Okay. Now let's start the discussion about how to calculate future value of delayed annuity. Look, it is same as we have calculated for ordinary annuity. The reason, even though if you are starting your investment after any time period after year 1, you will get the return. Your return will start once you will do the investment. So its formula is same as we have used for ordinary annuity. Again, I'm repeating, if you want to calculate the future value of delayed annuity, you will use the same formula which is used for ordinary annuity. Okay, clear? Now, how to calculate present value of delayed annuities? Okay, let's start. We have 3 years annuity which is going to start at times 2. So there is addition of the formula 1 plus r x raised per minus, and there is another typo error. It should not be minus, it should be minus, not multiply sign, minus. And this is called delayed annuity discount factor. So let's do the calculation. 1000 times 1 minus into 1.1 x raised per, this is important. Here n, you will use the last figure of your timeline, minus 4, not minus 3, divided by 0.1. So once you will do this calculation, it would be the sum of discount factors of from year 1 to year 4. Okay, so it is times 1.1 x raised per minus 4, 1 minus answer divided by 0.1. It is 3.169, 3.170 approximate figure, minus 1 plus r minus n. This minus n would be the year where you have no cash flow from year 1 onward. Like it would be 1.10 minus 1, which is 0.909. So 1000 times this would be the working. So minus 0.909, 2.261. So 1000 times 2.261 is equal to 2261. From these figures, we have concluded one thing. From all these figures, we have concluded one thing, which is, if we will talk about future value, then due future value would be greater than the future value of ordinary, and ordinary future value is equal to delayed future value. But if we will talk, you can confirm from the figures which we have calculated. If we will talk about present value, then due will be greater than ordinary, and ordinary will be greater than delayed. Okay, so this is the conclusion about whole discussion about annuities. Okay, then how to calculate present value of perpetuity? Perpetuity we have discussed already, that it is for infinite time period. It is for infinite time period. Here it must have a cash flow here 1000. So 1000 for infinite time period. In that case, for perpetuity, we will calculate only present value. We will not calculate future value. Annual cash flows times 1 divided by R. This is called perpetuity factor. So our annual cash flow is 1000 times, if our cost of capital is 10%, 1 divided by 0.1. So 1000 times 10 is equal to 10,000. So the perpetuity of 1000 for infinite time periods, present value would be 10,000. Okay. Then we have one other type of perpetuity, which is called growing perpetuity. It is perpetuity, it means it is for infinite time period, but it is growing at constant rate. Every year there is an increment, but rate is constant, same rate. So how to calculate its present value? Annual cash flows, instead you can say cash flow at year 0, cash flow at y 0 times 1 divided by r minus g. Okay, so this is called growing perpetuity factor, where g is growth rate. Okay, now let's do the calculation. If we have same formula and over there we have data, and over there we have 5% growth rate, 10% cost of capital as discussed earlier, and annual cash flow 1000. In that case, 1000 cash flow at year 1, sorry, not here 0, divided by 1 divided by r minus t, which is 0.10 times 0.05. So 1000 times 1 divided by 0.05 equals to 20,000. In this way, we will calculate the present value of growing perpetuity. Now, what is the importance of this subject? Time value of money is you are supposed to use discount factors in your capital budgeting techniques calculations, as well as you are supposed to use some formulas in your cost of capital calculations like growing perpetuity and ordinary perpetuities. The formulas of cost of capital are based on these things. So time value of money is very important topic. You must have to get a good skill on this. For this thing, you have to do maximum practice and to memorize and your formulas. That is important thing. Thank you very much for your precious time. I hope you may have enjoyed the lecture. See you next time, inshallah.